Alrighty guys, thanks for joining me. Today we're going to talk about a few things. We're going to be interpreting ICT's macros and we're going to be using these to our benefit. I'm going to go through a few examples both from the PM session, London session, and also the AM session from yesterday and the day before, because there's such good examples to go through. I'm going to pack this all into one video so you guys can have a look. So firstly, we'll start with the PM session. Now, if you've looked at the community tab on YouTube, you saw that I took this trade, short position roughly from here, right? Going short to target the sell side liquidity. Now, when I'm looking at the market, so for those that do trade the PM session, there's a couple things to consider. Now, what I'm going to do, I'm going to put timestamps on this video. So if you want to skip to something that's relevant to you, go for it. So if you're trading the PM session, there's a few things that, I would consider personally and that I consider personally. The first is going to be this. What has the AM session done? And all I mean by that is, has the AM session gone up, gone down? Has it consolidated? Would you consider the AM session to be a good session? Like, those are things, ask yourself, right? Ask yourself those things. Now, when I get to the PM session, I class the PM session from 1 o'clock onwards. And if I just draw a vertical line to represent that, so you can see here is 1 o'clock. So I've drawn that vertical line at 1 o'clock, as you can see. Let's make that a bit thicker. Now, if I look at the AM session, or even if I just look at the silver bullet from, 10 o'clock till 11 o'clock, well, guess what? That is horrible. Absolutely horrible price action. So often what happens, just to add on these points, if the AM session has done something poor, right? So if AM session performs poorly, the lunch hour or the lunch session or PM session should deliver, right? Really, really important to consider, right? So in this case, the AM session performed poorly. And all I mean by that is, 9:30, we see some volatility come in. Yes, we had a sell-off down here, but if you're talking strictly silver bullet, really poor price action delivery, really poor price action. Now, notice with this price action, I'm going to draw some trend lines. Now, I don't use this to see what's support and resistance. I don't do that, but I know people do. And look at how the market penalizes those people. They see this as support, we take that out. They see this as support, we take that out. And that was the framework for my trade during the PM session. So I already had this idea that, if AM session performs poorly, the lunch session or PM session should deliver. The lunch session, which is from 12 to 1, did that do much? Yeah, you could have seen this potential play from that bullish gap, gone for a long position. There's also a breaker block right here, so that there is a unicorn setup, right? So I'm just going to talk through this. That there is your rate and liquidity. And I'm going to summarize this. I've started doing this now just to make it quicker. So R stands for RAID. You've got a market structure shift here. Market structure shift for me is still MSS. And then you return to this bullish fair value gap, which if you want to grab out an optimal trade entry, you grab your Fibonacci from this low to this high. We don't quite get there, but we do come below equilibrium when the price comes back here. So I guess if you're trading the lunch hour, that's what you go for. Now, me personally, I don't trade the lunch hour. Sometimes it can be good, sometimes it can be kind of bad. So for me, I'll wait until at least 1 o'clock. Now, I got to the markets roughly about this point, right? So for me in Australia, this is quite early. I believe 2 o'clock is roughly about 6 o'clock in the morning, right? So it's quite early. It's still before 6 a.m. For other people, it might be a more reasonable time. So I'm looking at the market. I'm looking at what AM session's done. All the AM session has done is step down, little bit of a fake rally up, step down. I saw this little bit of a fake rally up. So my next thought process was, okay, we're going to step down again. Now, whenever I think of something, right, there's got to be some kind of confluence, right? Does it make sense for my idea to play out? And I always ask myself that, right? If I can't say yes to that question, then I shouldn't take the trade. Does it make sense for my idea to play out? Now, I'll tell you a couple of reasons why it does make sense. The first one that I was looking at, again, the market moves from premium to discount. So if I grab my Fibonacci from this swing high to this swing low, that's the last dealing range, right? That's the last dealing range. And let me just draw that out. And let me look at this section here, which is the optimal trade entry range, 0.618 to 0.786. Now, what I wanted to do was to see, yeah, we're sitting at this point here, are we in an optimal trade entry of the previous price swing to then sell off? Because when you're above equilibrium and you're moving down, you should sell. When you're below, you should buy. That's like a general principle. So here you go. I marked out this bearish fair value gap. It's a very small one, right? Very small one. So I call a bearish fair value gap a SIBI. It's exactly the same thing. Exactly the same thing. So I had a SIBI that rested within the optimal trade entry. See these two up close candles here. They represent a bearish order block. So to enter this trade, I had a SIBI in the optimal trade entry range. I had a bearish order block, right? We also had the fact that we were bearish since the AM session. And there's one last thing which I'll talk about, which is the trendline liquidity. Now, if you've seen other videos of mine, I love trendline liquidity. It's such a good target because I know that the market only moves to target two things: to fill imbalances, right, in the form of fair value gaps, or to actually take out liquidity. Now, where does liquidity rest? Liquidity rests where there's money. Where does money rest? Where people have their stop losses. So these lows here, there's many retail traders, support and resistance traders that are going long from here. That's where I want to target. Similarly over here, same kind of principle here, right? So, you know, you can talk about that as well as an opportunity to go short, but I took this opportunity. Now, what's even better here is you actually have an internal rate of liquidity. See that? You actually raid this swing high just by the tick. So we raid internal liquidity, and then I entered using an inversion fair value gap. That was the entry point, right? So if you have a bit of a look here, there's an inversion fair value gap like this, and that played out. Now, this similar philosophy I used to execute a trade over here as well, right? So we're going to talk through both those ideas. This one here being an inversion fair value gap. And let me just fix my screen. There we go. So this being the inversion fair value gap. And what happens? We target this trendline liquidity, right? So there's more than one confluence when entering a trade like this, right? So that's the first example. And look at how price trades through that, because this here is low resistance liquidity. Low resistance. The reason why it's low resistance is because these swing lows have not been taken out. We're just gradually stepping up. So all of that is low resistance liquidity, and a low resistance liquidity run is very short and very sweet. So short and sweet, tongue twister that one, but that's what it is, right? So that's the first trade, right? The second trade here, which, you know, I called out after the fact to my Discord, it was posted in there after, was this trade here. It's a good one to write in your journals too. So in this trade here, I was relying on what's called macros, right? And I know there's a macro from 315, right, to 345. Now, again, macros do one of, say, three things. They either raid liquidity, they create a market structure shift, or they do something important. So this here from 315, I'm going to write this up, 3:15 p.m. to 3:45 p.m. This here is a macro, right? So 3:15 to 3:45. So I like to enter in macros, or just after or just before, with the idea that they're going to provide. Now, have a look at this. This here, if we have a look, we're past this optimal trade entry range, but there's this SIBI, right? There's this SIBI right here. I had that marked out. Now, yes, we did break above it, but we automatically rejected it. So for me, that was the first thing that I saw. The second was that we were approaching a macro. The third is that we'd stepped up all the way here. We'd left imbalances here that we could target, right? And again, the market moves from premium to discount. So premium, discount, especially if it's a trending market. So we had that there. Then we had this bullish gap disrespected, right? That there becomes an inversion fair value gap. So a couple people have asked me, and I'm going to explain this here. Do I enter off fair value gaps, inversions? What's my preferred PD array? I like fair value gaps or fair value gaps inversed. So inversion fair value gaps or fair value gaps are my main two, because sometimes there's not going to be a fair value gap entry. Sometimes they will, but sometimes they won't. So having inversions and then also having normal fair value gaps kind of opens your doors and opportunities to actually taking part in the market. And I mentioned this in the Discord. I've also got a Twitter now if you want to check that out. The Twitter handle is just Full View Trading, so I'm going to start posting on there too. But I mentioned this, right? The fact that there's accumulation in that inversion fair value gap. That's exactly what you want to see. The way I see this, we're accumulating short orders. Now, the wicks tap back into this SIBI, right? They tap back into this bearish fair value gap. But where do the bodies stay? Where do the bodies stay? And that's the most important thing. As ICT says, the wicks do the damage, the bodies tell a story. In this case, the story that the bodies are telling me is that, okay, price is struggling to go higher. Doesn't make sense. Again, I ask myself this. Doesn't make sense for the price to go down? Yes, because we've left some imbalances here that we can target, and the market likes to target imbalances. Are we in a key time frame? Yes, we're in a key macro. We've just started the macro right here, and look what happens just after we had that first sell-off. Then price trades back up into this candle, which is a bearish order block, right? So I had that marked out on my chart. And all I did here, I went for a 1 to 2 risk to reward. Now you might be like, well, where was your stop loss? Where was your TP? Okay. Entry, right, as we came back into this zone. Stop loss, I believe was roughly about this point here, sorry. Stop loss was above this candle because there's no need that we should break above that. And again, that's already a 1 to 3. All I needed was a 1 to 2. So in these short scalping opportunities, you know, you don't need the price to run as far as you normally would for a trade that you might be sitting in for half an hour. So my trading strategy is a mix of short scalps like that, or trades that I might hold for 20 minutes, 30 minutes, and so on. For me, most of my trades, they're finished within half an hour. You know what I mean? So this one here was a short scalp. Of course, I could have rode it further. Of course, I could have done that. And if you have a look at price, this is the new dealing range. Let's grab our Fibonacci just to implement that point again from this low to this high. Again, the market moves from premium to discount. Premium, back under equilibrium, discount, right? Really, really important to consider. So premium, discount, right? So all the market did was come back into a level of discount, tap into a PDRA that was sitting in discount, and also tap into these candles, which are an order block, a bullish order block. So hope that kind of makes sense, right? And this is the PM session. So I'm going to make a note somewhere of the time frames that we're up to at the moment. I'm going to put these bookmarks in, but the PM session talk for yesterday's trade is going to end now, which is roughly about 12 minutes and 40 seconds. In the next section, we're going to be going through the AM session. We're going to be looking at macros and also talking about today and how you could have executed there, or if you could have waited, right? So I'll talk about that next. Now, before I do that, I just want you to visually see how the market targets this trendline liquidity, right? In this section here in Silver Bullet, there's no opportunity to go long. There's no opportunity to go long, right? So I just wanted to point that out. And now we're going to talk about the London session. So let's get into it. So yesterday, the AM session was quite poor. But in the London session, what you can see here, is a few things. Right now, whenever I'm trading the London session, this is always what I do. 10 minutes before, 10 minutes after, 2 o'clock, I'll mark that out on the chart. And we're going to see some patterns occurring here, right? And you'll see this in a second. That's the first one. And then the second main run is from 250, so 250 to 310. Now, what I'm marking out here are macros. You know I love macros. We know price is algorithmic. Time comes before price. Now, just look visually for a second. Notice how there's some kind of reversal in this macro and this macro. It happens a lot of the time. Back test this, forward test this. I said this in my last video, but use macros to your benefit. So again, what I see here generated, that there is trendline liquidity, right? We're bouncing off the same point. People have their stop losses there. What does the market do, right? What does the market do? Let me get that fixed. So that's 310 there, I believe. Cool. What's the market do? Right on 2 o'clock, right? You can see here, give or take, we have an impulsive move to the upside, and we end up taking out that buy side liquidity that I mentioned. So that there would have been your long opportunity if you're going in London session. Stop loss below these down close candles, targeting at minimum this swing high, which would have been at least a 1 to 2. So can you see how macros deliver price, right? Macros deliver price, and they do something important, right? So when I trade, I use macros to my benefit, whether it's the PM session, whether it's the AM session, whether it's the London session, 10 minutes before, 10 minutes after, there's always a macro. And then in PM session, like we talked about earlier, there's other macros we can talk about, right? And we had a look at that just before. So there's your first opportunity. And let's say you're a silver bullet trader. You're a silver bullet trader. So let me talk about this, right? If I just zoom out here, these are some previous highs. We didn't actually take those highs. And what actually happened, I believe there was some SMT from this high and this high compared to ES. I'm just going to confirm that in a second, and I'll get back to you with that information. But there was some SMT here that occurred. Now, SMT, smart money technique, right? I believe ES had taken out this high, whereas the NASDAQ hadn't, right? Now, that means that the NASDAQ is the weaker pair. So if you want to take shorts, you want to go into the NASDAQ. Then, watching price action, there was this bullish gap right here, which you can see. That got disrespected. That becomes an inversion fair value gap. Now, this is quite an interesting trade that you could have taken, and we'll talk through a few opportunities that you might have taken and how you could have executed based on that. But if you've got SMT, you've technically taken out this swing high here, so you have had some kind of rate of liquidity. Even though it's like internal, you have had some kind of rate. See this accumulation? I see this as accumulation, and I see this as like a mini power of 3. So I see this as accumulation, manipulation, and then the distribution leg that comes after, right? So that's one thing I want to point out. The next is that if you wanted to enter from a fair value gap, you might have drawn out this fair value gap here. And fair enough, that there is a bearish fair value gap, but why wouldn't I enter from this bearish fair value gap? Because it's not in a level of premium. It's not in a level of premium. It's too far down for me to execute. What I'd have to do if I was going to enter here, my stop loss, say I entered here, would have to be above at least this inversion. I'd get stopped at anyway, but even if I put above this high, yes, I would hit my 1 to 2, but for me personally, I do not want to be waiting, you know, an hour and a half just to get my 1 to 2. So for me, that's not a viable entry, right? Because it's not in a level of premium, right? It's too far down the move already. If I miss it, so be it, right? And what ends up happening again, there was some SMT created here compared to ES. So ES actually rated that high, NASDAQ didn't. We returned to that inversion fair value gap. Yes, we disrespected it, but then we sold off from there again. So if you entered this first time, you could have gone short from this return, stop loss above that high, and you would have got a 1 to 2, close to a 1 to 3. If you entered here again with your stop loss above the high, same kind of thing, but obviously the price ran further. So it's one of those things to consider, guys, when you're building an entry model. And this is what I use macros. That's like the foundation to my model. So macros is the first thing that I use. Macros being time. I use inversion fair value gaps and fair value gaps. And then if I see things like SMT or the 3 drives pattern, you know, or other things that, you know, might not require a rate of liquidity, then I keep that in mind too. So 3 drives is another reason why you might not need to rate a swing high, swing low. So I hope that kind of makes sense, right? We're going through a few things today, but I'm trying to break it up into different sessions because I know people trade London, some trade New York AM, and some trade PM. But all these lessons are valuable. It doesn't matter what session you trade, it's still going to be valuable based on the information I'm giving. So again, that's what we see there. Now, just to point out the importance of macros, have a look at this. Now, this is outside of the London Open session, which is from 2 a.m. to 5 a.m. But have a look at this, 550 to 610. Now, this is a perfect example of what I like to call a trend continuation model, right? So I'm going to mark out all the components here. We've got a rate of liquidity. We've tapped into this bearish fair value gap, and there's also a volume imbalance between these 2 candles. And look what happens here. Right, look what happens here. This is like a 2022 model. We have a market structure shift, and then we have a return to this fair value gap, which you can see. I'm going to mark that out as a SIBI. SIBI means bearish fair value gap. And what happens? We sell off, right? Now, a lot of people have been asking about the trend continuation model. It's still something that I'm working on, forward testing, back testing. But what I saw here, I saw this as the buy side of the curve, and now this as the sell side, because guess what, guys? You know I love my trend line liquidity. Look at all this. All of Asian session was stepping up. We didn't take out any Asian session lows. Even back here, all these extreme points were left. So my viewpoint was that, okay, we're going to take out those Asian session lows, and this is accumulation. That there is the original accumulation for the market maker buy and then sell model, right? So as price works its way up here, you can see you've got accumulation pockets, and then as price comes down, the actual model is complete when you take out that original accumulation, right? Yes, price comes down a bit further, but once we take out the original accumulation, the model is complete. So I see this as the buy side and that as the sell side of the curve. So in terms of the reason why this trade here still worked, even though you took out some of these lows, the first was that you still had Asian sell side here. Now, Asian liquidity for me is from 7 o'clock, right, which is right there, till 12 o'clock. And there's all this liquidity still to be targeted. Plus, if you're watching price, right, and let's assume you class this as a market structure shift. Again, grab the previous price swing from this high to this low. Where does that bearish fair value gap sit? It sits within the optimal trade entry range of that last dealing range. So if you're going to go long here, I would first be watching to see how it reacts from here, because we already know we've initiated some bearish order flow. And when did that happen? It happened here within the silver bullet. Right, it happened in the silver bullet in a key time frame. We've initiated bearish order flow. We still have Asian liquidity to target. So if you're looking to go long here, doesn't make sense. Does it really make sense considering you still got all this Asian liquidity and that accumulation? It's a riskier play. So this is how some people get caught up on fake market structure shifts, because they will draw this and they'll say, okay, that there is a market structure shift. And then their plans to enter when price comes back down into here. You enter from here, your stop loss would have to be all the way below this low, and you'd have to target all the way up here. The chance of it going all the way up here again, probably not likely, considering all these factors I talked about. Now, the only way I see you being able to take a long position here would be for a small scalp. A small scalp. So, for example, there's a bullish fair value gap right here, right? And again, this is outside of the London Open session, but there's a bullish gap here. And you might have gone for a long position from here, stop loss below this down close candle, targeting a 1 to 2, and you get that. But if you're looking to hold trades for a long time, just be mindful, right? Especially when you've got bearish order flow, or it could be bullish, the reverse. Just look at different PD rays, right? Whether in a discount or premium, and just see how price is reacting and see what order flow has already been initiated. So you can see here, the actual trade that would have been good to take would have been a short position from here, stop above that candle's high, targeting whatever you need to. And again, that there just shows the low resistance liquidity run of all this trend line liquidity. That's how the market behaves. Really snappy, really short, really sweet. So hope that kind of explains things. One more thing I'll say, if you made it this far, I appreciate it. I've got a free Telegram now that started, Full View Trading is the name. I'll be posting trades that I actually take there, but also just other stuff I see. Food for thought ideas. My Twitter's available as well. The Discord's online now, guys. But again, if you have questions, feel free to send them through here. And I will be doing a masterclass coming up soon, right? So sometime this week, potentially Sunday, in Australia, I will be doing a masterclass. It's been a few weeks now, so we'll get onto that. But I hope this kind of makes sense. Use macros to your advantage. Really, really important. And guess what? If a macro doesn't do something that you want it to do, then stay out. You know, because for example, there's a macro from, 350 to 410. Does that do anything that important? Not really. Like, it's just sitting in that zone. So the way I use macros, I either anticipate that they're going to do something based on the setup that's formed. I enter in a macro, like that could have been an entry, or this could have been an entry in this inversion fair value gap. Or I wait until the macro has actually done something or rated liquidity and then enter as a result or after that. So that's how I use macros. Up to you how you use them, but that's what I kind of do. Now, just so you guys can see how this works, we're actually sitting in a macro right now. So we're sitting in a macro right now. And the macro, even though, guess what? Even though it's before, any session, macros still perform. So if you have a look, the macro starts at 1050 and it ends at 110. Now, for this session, well, I'm going to post this video probably today, but here's my analysis for this session, by the way. Like, you can look at this later on. I see this as trend line liquidity. I do. I see imbalances down here that might need to get filled. I see this move up, right? I'm just going to measure this out. This high to this low. I see this move up as just returning potentially to optimal trade entry of that bigger dealing range, right? And then as we've returned to that area, we've actually sold off. So now, again, all I do is mark out the extremities. I've got some equal highs here that could be a target, that's buy side. And I've got some lows here that could be a target as well, right? And again, I use macros to see if they do anything important. If there's no setup there or I'm outside of time zone, I don't execute. Food for thought, right? So we'll come back in a sec, we'll review this, and if something important happens, then I'll let you guys know. But for the meantime, let's get into the AM session. Let's talk about this particular day here. Great example of using macros and talking about different ICT concepts. Really great example. So this is for all my AM session traders. I know some people from Australia here, they trade that, from America or other countries. Welcome to this part. Now, if you're watching this and you've skipped, I'd encourage you to go back and watch the other stuff too, because there's valuable information there that you don't get otherwise. Now, here's what I see. This is technically an accumulation area. We're stuck in a range here. This is also an accumulation area, but look at this. It's kind of like the power of three. You've got accumulation, manipulation, and then you've got distribution, all on a larger scale. So that's quite interesting. But here's what I wanted to point your attention to, right? Using macros again, use macros to your advantage. The first macro for the AM session is here, and it's from 950 to 1010. So that's 950, and here is 1010. Again, what does this macro do? It returns to this bearish fair value gap, sells off. That's your entry in the macro. Simple. Where do you target? Where do you target? Well, guess what? This low here, this is from the London session. So you can target that. Have a look. Notice how we made one low here, extremely close, relative equal lows. Market comes back up, you go short, that's your first TP. You keep holding, we deliver, right? Then we wait for the next macro. Now, price doesn't rate this low. I wonder if there was some SMT there. You might be able to confirm it, right? I don't really trade AM session anymore, but if there was, it'd be a beautiful example. But regardless, let's mark out the next macro, which is from 1050 to 1110. 1050 to 1110. Now, what do I see here? I see an inversion fair value gap entry right here. Boom. That there, that bearish gap gets disrespected when price closes right above here. When price trades back into it, inversion entry. If you don't like that one, go for this one. There's another inversion fair value gap. Now notice here, this is really important. Really important. If you made it this far, really important. Notice this accumulation in the inversion gaps. That's exactly what you want to see. That's exactly what you want to see, right? Accumulation in these inversion fair value gaps. It's accumulating long positions. Same thing happens here, right? Now, if you can match up an inversion with a bullish gap, even better. This one here, personally, I wouldn't take it, even though there's a bullish gap there too. It's too far up in the move. Me personally, I like taking things down here. I don't like having a really wide stop loss. It's just not my trading strategy. I'd rather take moves down the bottom or I miss out. Simple as that. So this entry from the macro, if you went for a long position, let's say you took this second one right from here, as soon as we close above. Where's your stop loss go? Below this candle. Now let me explain why. Below that candle, there'd be multiple PD arrays that would be being disrespected. You'd be disrespecting this fair value gap, this inversion, and also these two down close candles, and this candle here, which is a swing low. So if you do that and you're aiming for a 1 to 2, well, let's just move that up. You easily get that. Like, it was a really, really big move. Really, really big move. If you got this entry, well, you're laughing. Stop loss below that low, a 1 to 2. You get that even before we enter into this inversion fair value gap. So this is how you can use macros to your benefit, guys. You know, there's macros 10 minutes before, 10 minutes after every hour. If they don't do something you like, don't execute, right? So, you know, even just moving on to the PM session here. Notice how in the AM session, we've had a really big run up. And what happens in the AM session dictates often what happens in the PM session. Now, a run up like this, what happens in the PM session? Not much. Not much, right? Not much happens. Let's draw out some macros here. So let's go, for example, 150, which is roughly about here. Let's do another one to 210. Now, what happens in this macro? We raid some liquidity. Just by a tick maybe, or maybe we form equal lows, just by a tick. We have a market structure shift. We have a fair value gap. And this, by the way, is silver bullet 2 to 3. Get the Fibonacci from this low to this high. Try to enter in a level of discount below 0.5. Place your long position order right from there. Stop loss below this low. Targeting the next liquidity at least, or a 1 to 2. So again, you can use macros to your benefit. Even here, here's another great example, guys. Probably not a great entry at this point, but if we have a look here, 250 is another macro all the way to 310. Again, this macro delivers to sell side targets. Notice how we form swing points at these macros. Really important. And I'll just do one more just for this sake. There's another macro, of course, from 350 to 410, right? So I'm just going to do this as a last example. And notice how in this macro, it relies on what happened in the last one. So we return to this sell side imbalance, buy side inefficiency, or that bearish fair value gap, which, by the way, guys, I love to use this, sits within the optimal trade entry range of that previous price swing. So that would have been an opportunity to go short, right? Also, an added bonus, you've rated internal liquidity right here, plus you've tapped into this imbalance. So I hope you guys have got something insightful from this video. We've gone through macros, we've gone through AM session, London session, PM session, different trades, right? Different trades that you could take. And to be honest, I want to go through one more, and I believe this was from maybe last week, right? Last week. Just a little bonus if you're waiting, right? Little bonus. I'm going to label this bonus in the video. If anyone out there is looking for a very simple strategy, it's not always going to happen, but when it does, great to execute on. Measure the Asian range. Now the Asian range is from 7 to 12. So 7 o'clock, and I'm going to make this quick, just roughly 7 o'clock till 12 o'clock. So measure the Asian range. And in the Asian range, guys, mark out the lowest point and the highest point. Highest point, and this is the, let's say that there's the lowest point. Wait for one of those to get swept in a key time frame, which you can see happens here. When does that get swept, by the way? Right on or just after the macro during silver bullet. Wait for it to get swept. Once it gets swept, look for a market structure shift of some sort, and then either enter from the return to a fair value gap, or you can enter straight away from the shift itself. If there's an inversion fair value gap here, even better, but this is a bread and butter setup. So Asian liquidity, wait for that to get rated during a key time frame, and guess what? Target the opposing liquidity. In this case, you got all this trend line liquidity, and in this case, we actually target the opposing liquidity. Now, it's not always going to happen like that, but when it does, it's one of those trades where if you have a partial or runner, you can execute on that. So again, this is where I'm going to leave it, guys. I hope you've enjoyed this video. If you got questions, let me know. If you haven't voted yet, vote on the poll that I've posted on the community tab. I'm going to have a masterclass soon, so I'm getting those notes ready. And apart from that, guys, I appreciate all your support. And until next time, I'll talk to you guys then.